Welcome to today's Signature FD market update that we call Cutting Through the Noise. I'm your host, Tony Welch, Chief Investment Officer at Signature FD. And today we're going to be diving into some interesting market trends and data points, as well as some economic data. So let's go ahead and get started. So, first up, let's talk about some performance trends as it relates to the Super Bowl. The S&P 500 has gained a median of almost 13% per year when the NFC has won the Super Bowl. There have been 22 up years compared to 7 down years. Now, interestingly, these numbers are slightly better than when the AFC has been the winner. However, it is worth noting that the last instance of the NFC winning was in 2022, which did see a decline of about 19%. So let's hope that's not a new trend. Now, unfortunately, there is also some fascinating data, but not encouraging data around Philadelphia championships specifically. So, the Philadelphia Athletics won the World Series in 1910 and 1911, and those were during periods of market turmoil. And they won again in 1913, another recession year, and in 1929 and 1930 during the Great Depression. The Phillies won the World Series in 1980. That was a recessionary year. And in 2008, during the financial crisis, the Phillies also won. Now, the Eagles won in 2018, which was also a weak market year. So, again, let's hope that the market can buck some of these Philly championship numbers. All right, let's take a look at recent market returns. The S&P 500 was down about 0.2% last week, while the Russell 2000, which is a proxy for small caps, was down about 0.3%. The developed international markets were up about a quarter of a percent, and emerging markets were up 1.4% last week. Commodities were up slightly, and core bonds gained about 0.4%. The dollar edged about 0.4% lower. Now, all of these benchmarks, with the exception of the dollar, are up year to date thus far. So, market breadth is okay, not decisive right now, but certainly not breaking down. So far in 2025, it's been characterized by rotation. The tech sector is down for the year, and discretionary is the second weakest performer. Traditional value areas like financials, materials, and industrials are leading. Bull markets can continue with a rotation, but we shouldn't expect returns to be as strong for the broad market if the biggest sectors remain weak. So let's move on to some economic data from last week. The jobs data was solid, but not spectacular. Openings in December eased, but hiring did pick up some. The BLS report showed decent payroll gains in January, but November and December were revised higher, so that's encouraging. The unemployment rate fell from 4.1% to 4%, and average hourly earnings were up 4.1% year over year. And that supports about 2% inflation so long as productivity can grow about 2% a year. Now, the University of Michigan sentiment survey also dropped, with consumers expressing some concern that tariffs would lift inflation over the next year. Sentiment weakened across political affiliations, but there was certainly a higher jump in inflation expectations among Democrats than Republicans. So these consumer surveys, they have lost some efficacy over the last 10 to 15 years due to their political swings. In the week ahead, we have the actual inflation data coming up. Consumer prices is coming our way on Wednesday, producer prices on Thursday, and import prices on Friday. We're also going to get retail sales, which will be reported on Friday, and those will be some important things to watch. So checking in on the earnings season so far, 308 companies have reported, and that represents 72% of the market cap in the S&P 500. Earnings have grown almost 20% with expectations for 16% index level growth when all companies have reported. So this is quite strong and it helps to justify the elevated valuations. There's also about 12% expected growth for the S&P 600 small cap index. And there's 6% earnings growth for developed international markets and 13% for emerging markets. Overweight equity has been a good approach this year, but leadership has begun to shift. We may need to lean into a value approach if these trends continue. Currently, signature FD portfolios are evenly balanced between growth and value, and we've been overweight US stocks in general. So, a few closing thoughts here. The bull market remains intact, but there's been a bit of a shift in the leadership for that bull. There remains some economic momentum as evidenced by the job market, but consumer sentiment is taking a little bit of a hit here over policy uncertainty. Earnings growth looks to have been robust in the fourth quarter with positive earnings in domestic large caps, small caps, and international markets as well. And that's important as valuations, particularly for large cap domestic companies, are pretty elevated. So we remain overweight stocks in our recommended portfolio positioning, but the composition of that overweight could shift in upcoming weeks or months. So that's all for today's market update. Thanks for tuning in. And as always, have a great week ahead.